Most of us are taught a very simple formula for building wealth. You buy a piece of property, you wait for the value to rise, and then you sell it to cash in on that profit. But the moment you execute that sale, you trigger what the IRS calls a taxable event. Look at how this looks on a timeline graph. If your property goes up by $100,000 and you decide to sell, you don't keep the full amount. The government takes a cut of 15 to 20% for capital gains, leaving you with $80,000. You might have a pile of cash, but you've lost the underlying asset that was growing in value. Every time you sell, you reset your financial progress back to the beginning. Billionaire founders operate by different rules. This is why Mark Zuckerberg takes a $1 salary and avoids selling his company stock. Instead of selling, individuals like Elon Musk use their shares as collateral. They go to a bank and borrow against the value of those assets to fund their ventures. This works because of a specific rule in the U.S. tax code. Borrowed money is not considered income, and if the money is an income, it cannot be taxed. In this system, debt is a specific utility. As long as the underlying assets produce enough cash flow to cover the interest and principal, owners can access their wealth without ever triggering a tax bill. To map out a blueprint, here is our first gear: an appreciating asset. Say you buy a home for $400,000 and its value rises to $500,000. Rather than selling, you perform a cash-out refinance, borrowing up to 75% of that new value to pull out $95,000 in cash. The tenant's monthly rent pays down the loan over time. The asset is essentially paying for the debt you just extracted. You now have $95,000 in liquid capital that hasn't been touched by the IRS, and you still own the property that generated it. The barrier for many workers is getting that initial capital. If you earn a salary, the government takes a significant portion of your income every year before you have a chance to invest it. However, a recent shift in the tax code opened a path for W-2 earners to access the same strategies used by the ultra-wealthy. It involves short-term rentals, like Airbnbs. If you buy one of these properties and manage it yourself, the IRS reclassifies the activity. By treating the rental as an active business rather than a passive investment, you can use the property's paper losses to offset your W-2 salary. This blueprint advances through bonus depreciation. Compressing decades of expected wear and tear into the first year creates a massive $125,000 paper loss on a $500,000 property. If you earn $100,000 at your day job, you apply that loss against your salary, dropping your taxable income to zero. The $20,000 saved in taxes stays in your pocket. You combine that $20,000 with the $95,000 in tax-free debt to serve as the down payment for your next property, restarting the cycle. This creates a self-sustaining cycle. Eliminated taxes provide the capital to buy new assets, and new assets provide more deductions to eliminate future taxes. This raises the question of what happens to the debt when the investor eventually passes away. The strategy is to never pay the debt off. You grow the portfolio and borrow against the equity throughout your life. Upon your death, a rule called the step-up in basis takes effect. The original purchase price of your assets is legally reset to their current market value for your heirs. This resets the clock on capital gains. Your family inherits a multi-million-dollar portfolio with the gains wiped clean, allowing them to keep the assets tax-free. The owner's wealth grows across generations without the government taking a cut at every milestone. Meanwhile, a traditional worker pays a tax bill every April, losing a percentage of their earnings before they can ever be reinvested. There are two financial systems running in parallel. One is designed to tax the movement of money through labor, and the other is designed to reward those who hold and borrow against assets. Accumulating wealth depends on how you classify your capital. The wealthy prioritize debt and equity because, unlike a paycheck, the tax code treats those as off-limits.